Hello viewers, once again welcoming to you all through this educational channel Accounting Equation Academy. So once again I am here for presenting a class on the topic redemption of preference shares, which is very important topic of subject corporate accounting, and this is very helpful for the students of become level. And so with this purpose I am here presenting my class today. After a long gap onwards, I will try to upload my regular video classes to you all. Okay, so here on the topic redemption of preference shares, a brief information meaning is on the screen, so you can see that redemption is the process of repaying an obligation when the capital is raised by issuing redeemable preference shares. It is to be paid back by the company to such shareholders after the expiry of stipulated period. The amount of such shares will be paid back within stipulated years, that is 20 years of their issue, either out of the profits or proceeds of the issue of fresh shares. Redemption is the process of repaying an obligation. It is the process of refunding of money to the preference shareholders. That's I told you that company raised by issuing redeemable preference share capital, and it is repayable after expiry of stipulated period. It is the process of refunding of money to the preference shareholders. The term of issue contains that holder will at some future date be repaid the amount which they invested in the company. The redemption date is the maturity date, which specifies when the repayment take place and usually printed on the preference share certificate. Okay, this is the meaning for redemption of preference shares. And Companies Act 2013 specifies through the section 55 provisions for issue of preference shares as well as redemption of preference shares. Now on issue, the provisions have been provided by section 55. This is here. No company limited by shares shall, after the commencement of this act, issue any preference shares which are irredeemable. So, from 1st April 2014, from this date, Companies Act 2013 came into force. Onwards, this date, companies are not allowed to issue irredeemable preference shares. They are allowed to issue only redeemable preferences, and which is repayable redemption. Next point is given here. A company limited by share. Generally, it is talking about the companies which make offer to public for subscription of their security shares. It is authorized by its articles of association. Then only company can issue redeemable preference shares. Issue preference shares which are liable to be redeemed within a period not exceeding 20 years from the date of their issue. Within this period, company must redeem the preference share capital. Okay. However, a company engaged in providing infrastructure facilities, like company engaged road construction, bridge construction, company engaged in power generation, companies are engaged in telecommunication services. For all these companies comes under the categories of infrastructure facilities, and this company can issue the redeemable preference shares, but the period for redemption is 30 years from the date of issue of this redeemable preference shares. Here it is given subject to the redemption of minimum 10% of such preference shares per year from the 21st year onwards or earlier on proportionate basis at the option of the preference shareholders. On the terms and condition that the preference shareholders at the time of buying the preference shares accepted the option, and accordingly on these options company redeem their preference shareholders. So it is very clear that in case of manufacturing companies, the redemption period is 20 years. Within this 20 years from the date of issue, the share must be redeemed. And other than manufacturing industry or companies, in company, especially those who are engaged in providing infrastructure facilities, they can redeem the preference shareholders within 30 years from the date of issue. These are the issues, so these are the provisions provided on issue redeemable preference shares, and the provisions are provided separately for redemption, and which are called on redemption provisions, conditions for redemption of preference shares. Section 55 subsection 2 of the Companies Act 2013 provides that no such shares shall be redeemed except out of the profits of the company, which would otherwise be available for dividend, or out of the proceeds of a fresh issue of shares made for the purpose of such redemptions. This point is clarifying that the company can redeem the preference shares, and company has two options only. That is, one option is profit. The company must have the accumulated free reserves which is available for distribution as a dividend, that accumulated profit reserves. And the second option is that company can issue the new equity shares or preference shares, and the proceeds from issue of these shares can be utilized to redeem the preference shareholders. Point number B is saying that no such shares shall be redeemed unless they are fully paid. So any redeemable for the redemption of redeemable preference shares as per the Companies Act, the provisions is given that shares must be fully paid up. Partly paid up shares are not eligible for redemption unless they are made fully paid up. And point number C is saying here, when preference shares are redeemed out of profit, an amount equal to nominal value of the shares redeemed must be transferred to capital redemption reserve account. The capital redemption reserve should be treated as paid up capital of the company. Such reserves can be used for issuing fully paid bonus share to the shareholders. In case of such class of companies as may be prescribed and whose financial statement comply with the accounting standard, so central government recommended the certain types of companies falling under these categories, and they must comply with the accounting standard, and this is prescribed for such class of companies under section 133 of the Companies Act 2013. For this type of company, the premium, if any, payable on redemption shall be provided out of the profits of the company before the shares are redeemed. So premium payable on a redemption of preference share shall be adjusted out of profit and loss account, and it can be adjusted out of security premium account also in a case not falling under sub clause 1. So this is talking about this sub clause 1, this D sub clause 1. Above, the premium, if any, payable on redemption shall be provided for out of the profits of the company or out of the company's security premium account before such shares are redeemed. Now the next point is method of redemption. Preference shares can be redeemed using any of the following three methods. The proceeds of a fresh issue of shares. A company can issue new shares, equity or preference shares, and the proceeds from such new shares can be used for redemption of preference shares. However, the proceeds from issue of debentures cannot be utilized for this purpose. Only equity shares or preference shares proceeds are eligible for redemption of preference shares. And in this connection, the accounting treatment, that is the journal entries which are to be passed in the books of the company in connection with redemption of preference shares when it is out of fresh issue of shares. So then these are the journal entries are recorded generally in the books of account. And when redeemable shares are partly paid up, the following journal entries are recorded for making partly paid up as fully paid. So this journal entry is redeemable preference share final call account debit to redeemable preference share capital account. And on receiving the final call money, bank account debit to redeemable preference share final call account. So likewise, these journal entries are given here, and these journal entries are used for recording transactions relating to redemption of preference shares when under the first method, that is the proceeds of a fresh issue of shares. Our second method, which is called the capitalization of undistributed profit or free reserves which are available for distribution as a dividend, these profits can be capitalized by the company, means adding to paid up share capital. And here under this method, the redemption of preference shares carried on using distributable profit instead of issuing new shares. When shares are redeemed by utilizing distributable profit, an amount equal to the face value of the shares redeemed is transferred to capital redemption reserve account by taking away a part of the distributable profit. And in case company redeem the preference shares partly by issuing of new shares and partly from accumulated profit, distributable profit, so then it is called combination of 1 and 2. And here under this method, a company can redeem the preference shares partly from the proceeds from new issue and partly out of profits, and amount must be transferred to capital redemption reserve account to the extent of profit amount being utilized for redemption. Now, as per the Companies Act 2013 provided by section 55, that every company redeeming the redeemable preference shares out of the profit, they must create capital redemption reserve account. So what is the significance of creating this capital redemption reserve account is here that to protect the interest of the investors or creditors or debenture holders. And the provisions are given. The purpose of creation of capital redemption reserve account is mentioned as under. So all of you go through it, so you will understand this. Especially this is creating the security of creditors to protect their interest and as well as capital intact. When company is able to intact the capital, then automatically it will get the security. It will give the security to the creditors, and it will increase security of the creditors will increase owing to increase in the share capital, because capitalization of profit means the increasing of share capital. So now method number 1 that I am going to explain you with the help of taking a suitable illustration. A company has 807% redeemable preference shares of rupees 100 each, fully paid up. The company decided to redeem the shares on 31st December 2023 at a premium of 5%. The company makes the following issues: 2000 equity shares of rupees 100 each at a premium of 10%, and 1508% debentures of rupees 100 each. So proceeds from issue of debentures are not available for redemption of preference shares. So it is just given in the questions. The issue was fully subscribed and allotted, and allotment were made. The redemption was duly carried out. The company has a credit balance in profit and loss account rupees 11 lakh, and securities premium rupees 1 lakh balance available. Pass the necessary journal entries. So in the questions, number of redeemable preference shares are 800 and rupees 100 each. So total rupees 80,000 is repayable on redemption, and at a 5% premium. So then 5% of rupees 80,000 will be rupees 4,000. So here the total amount repayable on a redemption is rupees 84,000. 2,000 equity shares of rupees 100 each, rupees 2 lakh, and at a premium 10%. So 10% of rupees 2 lakh is 20,000. So rupees 20,000. So total amount received is 2 lakh 20,000. Since company has to redeem only face value, nominal value of share is for 80,000, but company had issued proceeds rupees 2 lakh. So here the company is not using its accumulated reserve, so whole amount of issue proceeds to be utilized for redemption of preference share, because the issued proceeds is sufficient for redemption of 80,000 rupees face value of redeemable preference shares, and therefore here without using the free reserve balance, company is going to redeem whole amount out of proceeds from new issue of capital redemption reserve accounts. Entry is not required here because company has utilized the new proceeds, that is rupees 2 lakh, and 20,000 it is a premium received, and 4,000 of this premium payable on redemption can be adjusted from this 20,000, or it can be adjusted from profit and loss account balance, which company has available balance is rupees 11 lakh. So this problem I am going to solve without using the accumulated reserve balance. So the whole amount shall be redeemed out of proceeds from new issue of shares, that is rupees 2 lakh, which is sufficient for redemption of rupees 80,000. So based on the explanations as shown to you, working calculations, so these are the journal entries are to be recorded in the books of company in connection with the transactions relating to redemption of redeemable preference share. The first entry, journal entry, is started with the issue of equity share capital at a premium. So here journal entries: bank account debit to equity share capital account and to security premium account. So this is the amount 2,20,000. So total amount proceeds received by the company is 2,20,000. Next entry, connection with the issue of debentures. So though the debentures are issued by the company, but the proceeds cannot be utilized for the redemption of debentures. This is but the journal entries can be recorded. So bank account debit to 8% debentures account, and it is given in the question that 1,500 debentures of rupees 100 is issued. So that is 1,50,000 the total proceeds received. Remember that the issue proceeds from the issue of debentures are not eligible for redemption of preference share. Only equity share proceeds and preference share proceeds are available for redemption of preference shares. And now the due entry for the redemption of preference share. Here the 7% redeemable preference share. So space is very short here. The share capital account debit, premium on a redemption account debit to preference shareholders account. This is the face value 800 into 100 80,000 and premium 5% is given in the question 4,000. So total amount payable on redemption is 84,000 including premium. And the next entry, that this premium is the loss, or premium on redemption is the loss of the company, so that shall be adjusted from the profit and loss. Here we can debit the security premium account also, but I debited here profit and loss account. You can debit here security premium account too for adjustment of premium on redemption. Okay, 4,000. And finally the amounts to be paid to preference shareholders on redemption. So this is preference shareholders account debit to bank account. So total amount paid is 84,000, and it is given in the question that date of redemption is 31st December 2023. So all these dates are of that 31st December 2023. Now I have taken one similar problem for your practice. So based on the above explanations, based on the above journal entries, you practice this problem. So this is the problem for practice is given. So you all practice this problem and be prepared for your viewers. Thank you.